Ladies and gentlemen, thank you for standing by, and I would like to welcome you to MHP's Q1 2026 results conference call on the 16th June 2026. At this time, all participants' lines are in listen-only mode. The format of the call is a presentation which will be followed by a question and answer session. So, without further ado, I would like to pass the line to Anastasia Sobotyuk, Director of Investor Relations. Please go ahead, madam.
Thank you, Daniel. Dear stakeholders, good day, and thank you for joining MHP's conference call covering our first quarter 2026 results. My name is Anastasia, Investor Relations Director, and I'm joined today by Victoria Kapelyushna, CFO of MHP. Together, we will present and discuss the company's operational and financial performance for the reporting period. Please note that today's discussion is based on the press release, financial statements, and investor presentation published earlier today. During the call, we may also discuss our outlook, strategic priorities, and future plans. These statements are based on our current expectations, assumptions, and assessments of market conditions, and are therefore subject to risks and uncertainties. We encourage you to consider these factors when evaluating the information presented today. With that, let us begin. We go on slide number 3 of the presentation. Before turning to our operational results, let me briefly comment on the macroeconomic environment in Ukraine. The Ukrainian economy continues to demonstrate resilience despite the ongoing war. Following the recovery in 2023-24, GDP growth remained positive in 2025, although the outlook for 2026 has been revised downward due to continued infrastructure damage, energy challenges, and labor shortages. Inflation accelerated during the first quarter, reaching almost 15% year-on-year in March 2025, driven primarily by higher food and energy prices. The National Bank expects inflation to gradually moderate over the medium term. The local currency, Ukrainian hryvnia, remains broadly stable, supported by the National Bank active management of foreign exchange market, with only a gradual depreciation expected going forward. Importantly for our sector, Ukraine's agricultural industry remains resilient. The 2025 harvest was stable despite challenging conditions, you remember that, providing a solid foundation for agricultural exports and food production. In addition, the 2026 sowing campaign has been successfully completed, with planting progressing largely in line with expectations, despite the ongoing wartime environment, supporting prospects for the upcoming harvest. Overall, while the operating environment remains challenging, the macroeconomic stability has been maintained, and we continue to successfully adapt our business to the evolving conditions. With that, let me move to our operational and financial performance for the quarter. We are moving to slide number 4 of the presentation. Turning to our financial performance, Q1 2026 revenue increased by 31% year-on-year to $1 billion, primarily driven by the consolidation of UVESA and continued growth of our European operations. Gross profit remained broadly stable at $162 million, as stronger contributions from our European business largely offset margin pressure in the poultry segment. Adjusted EBITDA, excluding IFRS 16, amounted to $79 million, compared with $111 million in Q1 2025. EBITDA margin was 8%, reflecting softer poultry market conditions, low profitability in agricultural business due to seasonal factors, and the initial impact of integrating of UVESA. Net profit was negative $85 million, mainly due to foreign exchange losses compared with gains in the prior year period. Looking at our export mix, poultry products remained the largest contributor, while grain exports increased year-on-year, reflecting continued diversification of our revenue streams. Overall, while profitability was affected by market conditions and integration-related factors during the quarter, our revenue growth demonstrated the benefits of geographic diversification and the strategic expansion of our European platform. Let me now provide more detail on the performance of our key business segments. Slide number 5 of the presentation. Looking at our segment performance, the business continues to benefit from increased diversification, with Europe contributing 35% of revenue and over half of segment EBITDA during the quarter. The poultry segment remained our largest revenue contributor, generating $453 million in revenue. However, the EBITDA declined year-on-year due to weaker poultry prices, lower sales volumes, and higher production costs, resulting in EBITDA contribution of $19 million only. The European operating segment delivered a strong performance, contributing $354 million in revenue and $42 million in EBITDA. The inclusion of US had a positive impact on both revenue and earnings and further strengthens our presence in key European markets. Overall, while the poultry segment faced a more challenging market environment, the growing contribution from our European operations and the successful integration of USM helped support the group's overall performance and demonstrates the benefits of our diversification strategy. Let us now turn to the operational highlights across our key business segments, and here I pass my word to Victoria.
Thank you, Anastasia. Good afternoon, everyone. Let's turn to poultry and related operations segment performance, slide number 6. Despite more challenging pricing environment in export poultry market during the Q1, MHP remained focused on operational discipline, with result reflecting the temporary impact of softer export prices. Total poultry meat sales volume declined slightly year-on-year to 152,000 tons, as reduced shipment to MENA were not fully offset by high exports to Europe. Processed meat volumes continued to grow, increased by 14,000 tons, supported by high production and our ongoing shift toward add-value product. Revenue for Q1 increased modestly year-on-year to $153 million, driven by stronger pricing and higher volumes of processed meat, alongside a significant increase in complementary product and other revenue, including biogas. On the same basis, revenue declined for $524 million in Q4 2025, reflecting softer pricing for poultry meat on export market. Gross profit decreased year-on-year to $60 million, primarily due to a low IFRS 41 biological assets revaluation gain compared to the prior year period and higher production costs. Decline comparing to Q4 last year reflected the continued deterioration in Europe export meat prices, and that carried through into Q1 2026. Adjusted EBITDA net IFRS 16 decreased year-on-year to $19 million, driven by lower gross profit and higher delivering and transportation expenses. The quarter-on-quarter decline was driven by low gross profit, while selling, general and administrative expenses remained stable compared with Q4 2025. Poultry price on export market continued to decline in Q1, however stabilized and showed positive dynamics in April-May. Looking ahead into 2026, we expect the overall cost and price environment to remain challenging, but current pricing gives us reason for cautious optimism as we move through the year. Turning to our vegetable oil segment, slide number 7. Revenue in Q1 remained probably unchanging year-on-year at $116 million, but increased significantly at the same period from $81 million in Q4 2025, reflecting recovery in sales volume and price appreciation across both sunflower and soybean oil. Sunflower oil sales volume recovered to almost the level in Q1 2025 and increased quarter-on-quarter, supported by launch of new sunflower extraction line, which increased oil yield and expand overall processing capacity. Soybean oil sales volume continued to decline both year-on-year and quarter-on-quarter, mainly due to the high international consumption of soybean oil and feed recipe and the absence of toll manufacturing arrangement in Q1. Adjusted EBITDA net IFRS 16 slightly improved to $3 million, reflecting the combined effect of volume recovery and favorable commodity prices. Looking in 2026, we expect some improvement in segment profitability, supported by gradual normalization of the raw material cost environment and higher production volume. However, the pace of recovery will depend on commodity market dynamics, and we remain cautious in our expectation for the near term. Let's move to the slide number 8, agriculture operations. Revenue increased to $99 million, driven by higher price across key crops, together with increased sales volume of corn and soybean to third party, which more than offset low wheat sales volume. Adjusted EBITDA net IFRS 16 increased to $39 million, supported by higher price of winter crops, wheat and rapeseed. Both winter and spring sowing campaigns have been full complete. The crop stands are in good condition across the group farming area. Favorable weather patterns and adequate precipitation of now support the outlook for crops yield at least in line with 25 levels. Looking ahead to 2026, we expect agriculture to continue delivering positive results, supported by favorable crop price and yield forecast, even as the fuel costs rise, helping offset lower results in our poultry operation and stabilizing contribution to total EBITDA. Let's proceed to the slide number 9. Several words about European operating segment. Revenue increased year-to-year to $354 million, driven by consolidation of UVESA, while decreasing slightly quarter-on-quarter as outbreak on African swine fever in Spain put downward pressure on pork prices. Poultry meat sales volume grew year-on-year, driven by high sales in both domestic and export markets, while processed meat volume remained stable. Average price for both poultry and processed meat held steady both year-on-year and quarter-on-quarter. Gross profit increased year-on-year to $65 million, mainly due to the UVESA effect, while the quarter-on-quarter increase was related to favorable IFRS 41 fair value movement, reflecting partial recovering of peak price in Spain in March and April. Adjusted EBITDA net IFRS 16 also grew, broadly in line with development of gross profit. Looking ahead to the remainder of 2026, we expect price for poultry and processed meat in the European operating segment to remain broadly stable, with sales volume continue to grow. This is expected to support steady growth in adjusted EBITDA, net IFRS 16 over the courses of the year. Slide number 10. A few words about our cash flow, debt and liquidity. Operating cash flow for Q1 decreased year-on-year to 14 million, driven by low cash earning, mainly reflecting negative trends in export poultry meat prices. Working capital representing an investment only 20 million in Q1 2026, primarily driven by investment in inventory and crops field ahead of sowing campaign, partially offset by consumption of agricultural produce harvest in 2025 and increase in payables. The investment was lower than Q1 last year, which had reflected one-off increase in receivables last year. CapEx decreased to 43 million, with capital development mainly across key strategic areas focused on the maintenance and modernization of existing facilities. Regarding debt, the increase in long-term debt and reduction in short-term debt reflected the repayment $550 million senior notes due to 2026 and the issues of the new Eurobond 550 due 2029. Cash position was around 518 million at 31st March 2026. By the end of the first quarter, the group complied with all banks' covenants. The group's acquisition leverage ratio increased to 2.6, below the defined limit 3.0, compared to the 2.5 by the end of last year. Few words about subsequent events. Subsequent to the reporting date, the group entered into the share purchase agreement for acquisition of stake of 100% in Nitsiakos, the leading vertical integrated poultry producer in Greece. The transaction is structuring in 3 tranches, through which the group will acquire 70% of share capital. With first completion expected, the first tranche, with completion expected in the first quarter of 2027, subject to customary closing conditions, including regulatory clearance. The group has also granted the existing shareholders a put option over the remaining 30%, accessible between 2030 and 2035 years. As previously disclosed, the consideration for the acquisition is based on a pre-agreed valuation methodology linked to the target's enterprise's value and financial performance, subject to customary adjustment for cash, debt, and working capital. In line with our announcement, the amount payable at each stage of the transaction will be disclosed at the relevant time. And now I give the floor to Anastasia.
Thank you, Victoria. In closing, despite ongoing challenges in Ukraine, we continue to demonstrate resilience across our operations, supported by our diversified and vertically integrated business model, as well as dedicated and professional team. At the time, we are making significant progress in executing our long-term growth strategy in Europe, as you mentioned. This includes the continued development of Perutnina Ptuj, the successful launch of our pet food business in Croatia, which is a part of Perutnina Ptuj Group, the integration of Uvesa in Spain, and the recently announced plans to acquire Nitsiakos in Greece, as you just recently elaborated. These milestones reflect our strategic vision of transforming MHP into a leading international food and agribusiness group with Ukrainian roots. By combining the strengths of our Ukrainian operations with a growing European footprint, we are building a more diversified, resilient, and sustainable business for the long term. Thank you for your continued support and trust in MHP. We are ready to answer your questions now. Daniel.
We will now move to the question and answer section. If you would like to ask a question, please press star 2 on your phone and wait to be prompted. If you are dialed in by the web, you can type your question in the box provided or request to ask a voice question. We'll wait just a moment or two for the questions to come in. Kind note that we can take the voice questions during the call, and after the call, the MHP IR team will get back to you on your written questions. Our first question comes from Stella Creech from Barclays. Your line is open. Please go ahead.
Thank you, and afternoon, everyone, and many thanks for all the updates today. There was 2 areas, if I could ask on. The first is on the Greece acquisition. So could you tell us why you decided to go ahead with another acquisition so soon after Uvesa? Would it also be possible to perhaps give an EBITDA guidance range in the same way that you did for Uvesa in the early days there? And you appreciate you're going to wait until make some kind of valuation type announcements, but any kind of indication at this stage about how that would be funded would be great. And the second thing I want to ask about was the short-term debt, and if you plan to pay down some of that short-term debt with cash or perhaps do some refinancing, that would be great. Thank you.
First of all, thank you for your question. Regarding it's a very good question regarding why we decided to provide the new acquisition. First of all, you need to understand during the whole our history, because during the last 15 years we were working about new acquisition, and try to find the right target for MHP in Europe. Unfortunately, or maybe fortunately, it is a very difficult job. And regarding when we, to find this company, we understand that it is a good company with what for MHP, what is very important, because we see a lot of room for improvement and a lot of and we see a lot of potential for growth. First of all, the Greece market demonstrates strong growth, poultry market. And we understand how we can provide growth on capacity of this company. And we see how we can improve cost of production, efficiency of the company. And that is why, and completely accordingly, our strategy, which we announced during the last few years, that the main target, the main strategy for MHP to increase our European business, pure European business. And we have very good track record with Perutnina, and we clearly understand how we can do it with right targets, not with all companies, but with right targets. And the second part of your question about how we will finance, you're completely right, and we discussed a lot during our issue with Eurobond. In general, yes, we understand that we will, first is one resources how we can provide acquisition, and finance acquisition through European debt. Which we can put in balance sheet of our European business. And you asked about the size of Nisiakos, it is a very, yes, as we announced in our press release, is the revenue around 500 million euro, and the approximate the profitability with the margin of this company today generates around 8-9%. And the second question about our short-term debt. Right now our short-term debt 350, but at the same time we always have the same level of short-term debt during the few last years. Our short-term debt for financing our current assets approximately $300 million. Thank you.
Thank you very much. Our next question comes from Alexei Soroka from Amundi. Please go ahead. Your line is open.
Yes. Hi. I hope you can hear me. Some of my questions have been answered, but maybe we can go back and focus on your poultry business, just because I also dialed in late because I double booked. Maybe you can repeat that. In terms of some underlying margins, just explain what's going on, what impacted the margin in the first quarter, and what you expect the overall effect to be, and maybe refresh guidance for the full year if you haven't done so. Or if you have done so earlier in the call and I missed it.
Thank you for your question. Thank you for your question. Yes, as I told during the presentation, the segment poultry, now we are in very challenging environment. It's the main reason why we have the low financial result in the first quarter is the low export price, especially low price export price in Europe. Is the main, as we understand, especially in the first quarter. To be honest, always is the first quarter is the low season, and now we see some signal for slightly improving price. But anyway, even today, European price remain is a low level that, for example, compared to the first quarter last year. That is why we understand that for 2026, our poultry segment will generate worse result compared to 2025. But at the same time, our expectation, and we see the better financial result in agriculture segment, in European operation segment, even in Russian segment. And if you speak about, it's very difficult, to be honest, to announce to forecast our EBITDA for full year, but we try to be conservative, and our current expectation about 520, 550 our EBITDA for whole company for 2026. Okay, thank you.
Sorry, the European prices, how much lower are they year on year? I may ask so that I have some sort of understanding.
European price is now lower compared to the first quarter, for this fourth quarter, approximately by 15%. Despite on the product, but if you speak about the average, around 10-15% below.
Year on year.
No, fourth quarter compared to the year on year, it would be around only 5%. But you understand that in the first quarter, we had significant increase in our cost production. Not significant, but increase because we have very cold winter with temperature minus 25 degrees. And price of electricity, it was very high in Ukraine during the first quarter. And that is why our cost of production in first quarter was by around 7%, 8% high compared to the last year on year. Today's situation more or less stabilized regarding cost of production.
Okay, thank you very much.
Thank you very much. Our next question comes from Natalia Shpygotska from Dragon Capital. Your line is open. Please go ahead.
Good afternoon. Thank you very much for the presentation. I have a clarification question on the company's operating cash flow, please. During presentation, it was mentioned that weaker operating cash flow came due to weaker poultry segment results, but as I see, poultry segment cash EBITDA before IFRS 16 and IAS 41 stood only like 25 million lower year-on-year, while operating cash flow before working capital changes declined by roughly 70 million. Would you please elaborate on what also drove the operating cash flow lower? Thank you very much.
Your question, Natalia, if I understood your question correctly, your question about why we have the operation cash flow better in changes than our financial result, yeah?
Operating cash flow change worse than the profitability on a cash basis.
Operation cash flow, it is the way you look from segment result, yeah? Operation cash flow, because operation cash flow after investment in working capital, yeah. But at the same time, as I told, the investment in working capital this year was slightly less than last year. Your question about just poultry segment or about our full?
No. Full cash flow operations that declined from $101 million in first quarter 2025 to 34 in first quarter 2026.
No, because it is because unfortunately I don't see real figures right now, yeah, and maybe it is after payment, interest payment, yeah.
I guess so.
Yeah, and that is why it's a big difference, yeah. And that is why it seems to me the difference, net cash flow operation, last year it was 45, this year 14. Yes? Because now I see in our report.
Yes, this is after working capital changes, but before working capital changes, the decline is much more material, like from 101 to 34.
No, maybe interesting. Well, Natasha, maybe we will discuss with you because unfortunately.
Sure, thank you very much. Thank you.
Okay.
Thank you very much. Just a reminder, if you'd like to ask a question, please press star 2 on your phone and wait to be prompted. If you are dialed in by the web, you can also request to ask a voice question. Our next question comes from Dmitry Ivanov from Jefferies. Please go ahead. Your line is open.
Hello, can you hear me?
Yes.
Yes, we can.
Yeah, thank you very much for the presentation. I have a few questions. If I may, I will maybe ask them one by one. Maybe the first one is just, can you repeat the EBITDA margin at Nitiako's business? Was it 8 or 10% EBITDA margin you mentioned?
No, 8-9.
8 to 9. Okay. And how much debt is there like now? How much debt?
No, to be honest, we were ready to describe this information. Not right now, yes, for the next year when we will have the first tranche. Because to be honest, we provide announce about this company, and to be honest, we don't want to provide some special information on just only in one conference call. Okay?
Understood. And the first stage of acquisition will result in ownership of above 50%. So you will consolidate it after the first stage of the transaction.
Yes.
Yes. So yes, right? The positive answer. Okay.
No, yes, we have the few options, but our aim, to be consolidated. But anyway, we have the other option. We're flexible.
Okay. Maybe just like another question. Your leverage, like calculated under covenant, is 2.8 times. I remember you did some calculations for OS on some kind of expected pro forma net leverage. I'm just curious if you've done these calculations for this, like pro forma acquisition of Nitiakos, what's like expected increase in net leverage with this acquisition? Will it go above 3x as like net leverage, or like just any color?
Yeah, we understand, and our target after acquisition, we must be in average below 3.
Okay, so pro forma acquisition, you will be below 3.
Below 3.
Okay, that's
close to, not just below, significant below 3, believe me. Close to the 3, but anyway, below 3.
That's helpful. Thank you very much. So a few more questions from my side. I think you mentioned EBITDA guidance of at least 520 to 500, so at least 520 million for this year, right, basically. And in first quarter, you already like generated 87 million, right, basically. I'm just trying to do like a simple math. So basically, your guidance implies that in the rest of the 3 quarters, you will generate around 145 million EBITDA each quarter. So it implies like material increase in quarterly EBITDA generation from Q1, right, basically. You already mentioned like...
It's very simple. Sorry for my interruption. It's very simple explanation because first of all, agro segment, you understand, 40% of our business, of our contribution of EBITDA, it is a farming business. And the biggest part of farming business, generate mostly in the second, third, and fourth quarter. In the first quarter, close to the 0.
Understood. So basically, we should expect
the first quarter. Always in the first quarter, we have during all our life, the first quarter, we have the lowest financial result. The lowest.
That's very helpful. Okay, that's helpful. Okay, so basically, we will see material improvements in the next quarter.
Yes.
That's helpful.
Yes.
CapEx guidance. You previously guided 250 to 275 million for the whole group for the year. Is it still the same guidance?
Yes.
Or you changed it?
Yes, it is still the same guidance. Yeah, it's still the same guidance. Yeah.
250 to 75. Okay, that's helpful. And like probably last question, basically, I'm just I'm looking at your liquidity position. You're kind of sitting on $500 million cash at the moment, like $518 million. And like, I'm just trying to understand why do you need so much cash on your balance sheet, right? Basically, like it's $500 million cash. Like any expected other like material outflows you should expect? Like because $500 million is a lot of money.
Yeah, Dmitry, it is very good question, but it was on the 31st of March. Now, in our cash position, because you did not ask me what is the current our cash position. Our current position around 300 million. And internally, we have the rules we would like to keep as minimum, because you understand what condition we are living, and our minimum cash position around 200.
And why did it go to 300 million? Did you repay any loans? Like because like your cash position went down by 280 million. So what happened?
No, because first of all, yes, we repay some a little bit. Yes, we repay some loans. Yeah, because you're completely right. 500 position is big, and we have some investment in working capital regarding our agriculture campaign.
So it will be working capital outflow in the second quarter, right? Basically,
it is because it's temporary, but it's always.
Okay, are we talking about like 10, 20, or $50 million, like approximately?
Approximately what? Now on the balance sheet we have around 300.
No. The question: how much in working capital outflows we should expect in the second quarter of this year?
Yes, we have the clear target. Yeah. We have the clear target because we would like to have reinvestment in corporate capital for full year around minimum 50 million. Because last year we have the huge investment in working capital, and our target provides optimization all our position, current assets, and as a minimum we would like to have reinvestment 50 million.
Okay, that's helpful. I'll get back into the queue. Thank you very much for your answers.
Thank you.
Thank you very much. Our next question comes from Mary Gachania from Salik. Your line is open. Please go ahead.
Thank you for the presentation. Mine is a quick question about EBITDA. You mentioned that the expectation is that year-end is 520 to 550. How much of it comes from UVESA, and what portion is from of the group before UVESA? Thank you.
Our total EBITDA from our European segment, Perutnina UVESA, because we consider it is one segment for this year, around 160 million.
Okay.
Thank you very much. Our next question is a follow-up question from Stella Cridge from Barclays. Your line is open. Please go ahead.
Thank you so much. If I could just follow up on the UVESA, it did look like EBITDA jumped quite a bit quarter-on-quarter, and I know that you were experiencing the impact of the African swine fever towards the end of last year. Could you just talk us through kind of what happened in Q1 and why you saw such a pickup in EBITDA?
Yeah, no. Yeah, especially now, yes, it is the quarter-on-quarter. Your question about fourth quarter last year, and this it is a difference about revaluation of pigs. Yeah, because in the first quarter we have negative impact result of IFRS 41. Here situation with pork price in Spain was stabilized, and that is why we have revaluation, positive effect. This is the main reason why difference.
Okay, that's super. I mean, it's been very helpful that you've been adding in these new disclosures around UVESA. I think, anything that we can perhaps have in terms of more information around that would be great as well going forward. Thank you.
Thank you very much. Just a reminder, if you would like to ask a question, please press star 2 on your phone and wait to be prompted. If you are dialed in by the web, you can also request to ask a voice question. Our next question comes from Vidi Vera from Goldman Sachs. Your line is open. Please go ahead.
Hi, thanks for the presentation. Wanted to get some more color around the European operating segment. Last year we see IAS loss of $17 million versus a $14 million gain in 1Q. But I understand these are like non-cash adjustments, and if we adjust for that, the EBITDA actually declines, and the margin is also quite low. So wanting to hear from you, how do you look at profitability, and how do you expect this cash EBITDA, which is after adjusting for IAS, how do you see that evolving? Thank you.
Okay, yes, you're right that effect of 41 standards is non-cash, but your question about year-on-year on quarter-to-quarter? Sorry?
Year-over-year.
Year-on-year, yeah?
Yeah.
But yeah, if you look at year-to-year, our EBITDA even exclude effect of 41 standard increase. Yeah. Increase, because last year it is completely understandable because we include the financial results from UVESA. Because for me it's very strange why you tell that EBITDA decreased. Because if you look at year-on-year, exclude effect of 41 standard, our EBITDA increased by by 10 million, yeah.
Sorry, yeah, but the margin.
No, okay, maybe you... Margin maybe decline, but yes, okay, maybe we will send to you some explanation because regarding margin. But at the same time, we understand it's very important that in the first quarter we have the bad influence, especially in US, in pork segment, because we have very, very low profitability in pork segment because it was avian swine flu last year, and the situation now has stabilized. But anyway, today the price of pork very close to the cost, but at the same time we see the trend for improvement. And that is why we saw that situation. And other very important point, especially in US, always price in the first quarter the lowest because it's a low season, and price will improvement, and cost of production we do a lot of improvements in the US, and we expect significantly better result in the second, third quarter, especially in US. Thank you.
Just a final reminder, if you'd like to ask a question, please press star 2 on your phone and wait to be prompted. If you are dialed in by the web, you can also request to ask a voice question. We'll wait just a moment or two for the next questions to come in. Our next question comes from Antonio Gomez from 91. Please go ahead. Your line is open.
Hi there. Thank you for your time. I just kind of wanted to break down the cost increases in the poultry segment on the quarter, please. So it seems like you have both lower gross margins and higher SG&A if you're looking year on year. Could you just break down what's happening in terms of the cost increases, why the gross margins have fallen significantly, and also the same with the SG&A? Is it, you mentioned increased freight costs. If you could just give a little bit more detail there, that'd be helpful. Thank you.
Yeah, thank you for your question. Regarding SG&A, if you compare the quarter to quarter to SG&A in poultry segment, completely the same level. Because yes, we last year in 2025, in the second quarter, we had some changes in SG&A regarding increased salary, increased logistic costs, transportation. But if you compare the fourth quarter 2025 with first quarter 2026, our level of SG&A in poultry segment completely the same. The second issue, yes, cost of production chicken meat increased compared to the last year approximately by 7%. Is the main contribution was because we consume more gas. Consumption of gas was significantly higher compared to the previous year due to the weather condition, temperature -25, and the price of the gas higher by approximately 40%, and electricity price was higher year to year, almost 60%. It is the main contribution for increase our cost of production.
So going forward, looking at the rest of the year for the poultry segment, it sounds like the SG&A costs are not something that are going to go down. Is it the same for the cost of sales?
Yeah, Antonio, the SG&A cost will be the same which we had in the first quarter. During the 2026, I don't see any signals and any driver for decrease. Yeah, but at the same time, we don't expect any increase. It is good. Regarding cost of production, our expectations, the cost of production year to year will be not 7-8%, will be high, approximately by 4-5%. No, because, for example, right now, situation with electricity, with price of electricity has stabilized, and for full year, our cost of, with current price of grain, because maybe from the new harvest it would be higher price. Yeah, we will see. But now we see that cost of production will be high approximately by 4-5%.
Okay. So from a quarterly run rate, that poultry segment going forward, what's the kind of EBITDA that it's gonna be able to generate? This quarter seemed relatively low. You're implying it's gonna get better. Is it gonna be around the $50 million run rate per quarter, 60, 70? I mean, your high last year was 80, so just trying to get a range here.
No, as I told previously, that we understand that our EBITDA from poultry segment this year, because now we stay in a very challenging environment, will be lower than previous, but it will be compensated partially by a better result in agriculture segment and in our European operation segment. But it would be low.
Okay.
Due to the cost of production and a special price, export price.
So from a run rate perspective, on a quarterly EBITDA perspective, is that something you could give the guidance to?
No. I cannot provide any guidance, especially for poultry segment. Yeah, we will provide guidance for full our financial result. Thank you.
Thank you very much.
Okay, I'm not seeing any more questions. Thank you all for sending your questions. So perhaps I can hand back to the MHP team for the closing remarks.
Thank you very much. Dear stakeholders, it was a great opportunity to receive all your questions you were interested in. Thank you for being with us during the call. And of course, if you would like to have a meeting with us, raise other questions and discuss any questions which remained outstanding, please send me a message by email and or directly the questions which you would like to be answered. Thank you and have a lovely day. Bye-bye.
Thank you so much. Good day. Bye.
That concludes the call for today. Thank you all and have a nice day.